That initial sell order, it touched off a 9% nosedive in the Dow, and suddenly every alarm in the building was screaming bloody murder. One trade, one solitary click. The whole market went into free fall, and the floor of the New York Stock Exchange, usually a zoo of yells and blinding monitors, froze like a deer in headlights. The price feeds turned blood red in seconds, the screens flickering like a dying bulb, and in a cubbyhole tucked away on some anonymous floor, a trader's cursor blinked at him like a dare. Source: SEC report. His fingers hovered over the send button, the weight of the moment pressing down. The second that order shot out, every automated program out there lit up like Christmas trees on ecstasy. One bot's panic became the next bot's cue, and the whole system spiraled into a feedback loop of fire sale prices. Liquidity just vanished. The S&P 500 and Nasdaq went into free fall, and suddenly investors were choking on thin air, watching their portfolios evaporate in real time. Phones started ringing off the hooks, brokers were hollering like it was the last call at last call, and the numbers on every screen turned into a red tidal wave that no human hand could stop. Source: NYSE report. By the time the dust settled, the Dow Jones Industrial Average had cratered 9%, and trillions of dollars had evaporated in what felt like the blink of an eye. The trader who'd triggered it all wasn't some Bond villain hedge fund king sitting in a penthouse. Nah, he was just a faceless algo desk at some mid-tier brokerage, doing what he thought was a routine block trade to unwind a position. The system flagged it as large, but nobody could have guessed it would turn into a match tossed onto a gas-soaked floor. Source: CFTC report. That block wasn't supposed to be the spark, it was supposed to be the cleanup crew. But when it hit the order book, the high-frequency trading vultures dove in like sharks in a feeding frenzy. Every price drop fed the next sell program, and the whole thing became a runaway train with no conductor. Within 10 seconds, market makers bailaid like they'd seen a ghost. Quotes vanished, the Nasdaq's depth crumbled, and the S&P's price bars juddered like a flatlining EKG. The safety net gone. In a heartbeat, the crash had gone global, shaking futures, commodities, and currencies like a leaf in a hurricane. Source: Wall Street Journal. Regulators were left scrambling, but the real damage wasn't just the numbers, it was the hidden aftershocks, the kind that don't show up on any ticker until it's too late. Our team dug through the SEC, CFTC, NYSE, Wall Street Journal, and Financial Times investigations to piece it together. Source: SEC report. The SEC's autopsy said it plain. That single massive sell order was the match, but the automated trading ecosystem was the accelerant. It wasn't just the size, it was the speed. The market was already wired for HFT speed, and that order moved through it like a wrecking ball through a house of cards. The CFTC later fingered the interaction between high-frequency firms and market makers as the engine of the crash. Algos were racing each other in milliseconds, outbidding and out-panicking until the whole system seized up. Source: CFTC report. NYSE data showed liquidity disappearing faster than a magician's rabbit. 1 second it was there, the next it was ash. That's how the Dow lost 9% in what felt like a single breath. Traders with orders in the book watched them rot. Others saw their positions melt as bid-ask spreads yawned wider than the Grand Canyon. Source: NYSE report. The Wall Street Journal's deep dive nailed it. A combo of a monster sell order and algo traders yanking liquidity like it was a tablecloth at a kid's party. Their reporting painted a market where humans were spectators in a race run by machines, one that mistook a single trade for a 5-alarm fire and hit the eject button en masse. Source: Wall Street Journal. Over at the Financial Times, they called out the regulatory blind spots that let this happen. Circuit breakers, market maker obligations, cute ideas, but they crumbled under the pressure of a coordinated, ultra-fast liquidity exodus. One order and the whole system's shock absorbers turned to dust. Source: Financial Times. So what really let that one trade snowball into a full-blown market meltdown? Blame the plumbing of modern electronic markets. Order flow data hits thousands of trading bots in real time, and every one of them is programmed to protect its own hide. When that sell order dropped the hammer, the bots saw a price dive and panicked, canceling quotes, withdrawing from the book, stripping away the market's cushion like vultures picking at a carcass. Source: SEC report. And then the second wave hit. Algos designed to profit from chaos swooped in, driving prices even lower. Lower prices triggered more cancellations triggered even lower prices. Rinse, repeat. By the time humans could even think about hitting the brakes, the damage was already done, and the market's supposed self-correcting mojo had been left in the dust by algorithms moving faster than thought. Source: CFTC report. Regulators later found out the hard way that those circuit breaker thresholds were tuned for slow-motion slides, not the warp-speed plunge created by bot-on-bot warfare. The SEC admitted the big sell order was the fuse, but the automated trading web was the explosion. No single player meant to torch the market, but the system's design made it inevitable once the first domino fell. Source: SEC report. What nobody saw coming was how fragile the market really was, how a routine trade could turn into a Molotov cocktail in a system where every millisecond counts. That hidden fragility, it lurked in the code, waiting for the right spark, and when it hit, the market screamed before the regulators even knew they were under attack. Source: Financial Times. When the smoke cleared, the crash rewrote the playbook. Exchanges scrambled to fix liquidity gaps, new safeguards raced onto the scene, and the whole industry started arguing over whether humans should even have a seat at this poker game anymore, or if the deck was stacked too high. Source: NYSE report. But here's the kicker: the big question still hangs in the air like a storm cloud. Could another single trade buried in the billions that fly around every day set off the same chain reaction before the system gets its act together? Source: Wall Street Journal. The answer's gonna depend on two things: whether regulators can patch the holes the Financial Times exposed, and if the big players will rewrite their algos to actually see the feedback loops they've been fueling before another modest sell order turns into a full-blown catastrophe. Source: Financial Times. Next up, we're ripping open the 2010 flash crash like a piñata. We'll trace that one sell order from the first click to the final meltdown, uncover the secret deals done in the shadows, and show how a few lines of code rewrote the rules of finance in less time than it takes to microwave popcorn. Source: SEC report. Stick around, we're following the data trail, the whispers from the trading pits, and the silent code that reshaped Wall Street while most of the world wasn't looking. Source: CFTC report. In 2010, the flash crash erupted as a chain reaction inside a tightly knit electronic ecosystem. At the heart of it all sat high-frequency trading, HFT algorithms, little software agents that scan order books, hunt price gaps, and fire trades in microseconds. Back then, the go-to-HFT tactic was statistical arbitrage, with firms posting buy and sell orders side by side on correlated instruments to cash in on brief price differences. These bots kept refreshing their quotes non-stop, yanking liquidity the moment their risk models sensed a market wobble. Their decision loops receive data, compute risk, then cancel or send orders, usually wrapped up in under 10 ms. That lightning-fast feedback meant a sudden order flow shift could get magnified long before any human could even blink. It all kicked off with a single, hefty sell order from an anonymous trader. That order was sizable enough to eat up a big chunk of the depth on the electronic venue, and it was funneled straight to a major futures exchange. The SEC's probe says, a large sell order executed by a single trader triggered a cascade of automated trading that caused the rapid price decline. Source: SEC report. It hit the market in early afternoon, right when activity usually peaks, so it ran straight into the busiest HFT players. As soon as that sell order landed, market-making algorithms with standing offers on the other side sprang into action. Those makers are wired to guard inventory limits, so when sell pressure rose, their risk gauges blew a red flag, forcing them to cancel their pending bids. The CFTC report puts it this way: the interaction between high-frequency trading firms and market makers as a primary driver of the price dislocation. Source: CFTC report. Basically, the sell order peeled off the liquidity the market makers had provided, leaving the order book razor thin. NYSE data shows just how fast the depth disappeared. In seconds, the depth charts went flat, barely any buy orders left, a few ticks above the best bid. The NYSE report puts numbers on it. Liquidity evaporated within seconds, leading to a 9% drop in the Dow Jones Industrial Average. Source: NYSE report. The picture of the order book imploding is stark. The top bid level vanishes, then the next, and so on until only a few stale orders linger. Once the order book was stripped, every follow-up sell order hit the price way harder. HFT bots that focus on liquidity provision felt the thinning depth and, per their risk rules, pulled more quotes. At the same time, momentum-driven algorithms saw the plunge and started selling to dodge losing positions. That two-pronged reaction forged a feedback loop. Each liquidity pullback sped up the price slide, which then made more algorithms bail. The Wall Street Journal mapped it out, noting the flash crash was traced to a combination of a massive sell order and the rapid withdrawal of liquidity by algorithmic traders. Source: WSJ article. The cascade wasn't just about orders disappearing. It also featured price-level cascades across linked instruments. When the S&P 500 E-mini futures plunged, correlated stocks and ETFs fell in lockstep, triggering cross-asset HFT strategies. Those strategies, based on statistical ties, read the shock as a cue to unwind, piling sell pressure on stocks unrelated to the original futures trade. The upshot was a systemic amplification that rippled the shock through the market's microstructure. Later regulatory analysis shone a light on the blind spots that let this amplification run unchecked. The Financial Times observed, regulatory blind spots allowed automated systems to amplify price swings without human oversight. Source, FT article. Back then, circuit breaker thresholds were set for big picture moves, not the sub-second jitters HFT creates. So the market missed a real-time safety net that could pause trading while the order book rebalanced. Bottom line, the trader's sell order was a catalyst in a fragile electronic setting. Algorithmic market makers, shackled by inventory risk limits, pulled liquidity almost instantly. Momentum-driven HFTs, seeing the slide, piled on sell pressure. Together they created a self-reinforcing spiral that wiped out depth, drove prices sharply lower, and spread the shock across asset classes, all in a matter of seconds. Grasping this mechanism matters. It shows how one big order can spark a market-wide dislocation when the surrounding infrastructure favors speed over resilience. The 2010 flash crash still serves as a warning about what occurs when algorithmic speed outpaces market safeguards. Sources: SEC report. The investigation concluded that a large sell order executed by a single trader triggered a cascade of automated trading that caused the rapid price decline. CFTC report. The report identified the interaction between high-frequency trading firms and market makers as a primary driver of the price dislocation. NYSE report. NYSE data showed that liquidity evaporated within seconds, leading to a 9% drop in the Dow Jones Industrial Average. Wall Street Journal. Journalists traced the flash crash to a combination of a massive sell order and the rapid withdrawal of liquidity by algorithmic traders. Financial Times. The FT analysis highlighted regulatory blind spots that allowed automated systems to amplify price swings without human oversight. A red flash lights up the screen. One lone sell order, nothing more than a digit on a screen, pummels the market. In a matter of seconds, the whole thing snaps. That was the instant the algorithms started fighting each other. Source: SEC report. It all began with a trader out of Kansas City. He wasn't a rogue, just a shop doing a routine hedge. But this wasn't any ordinary market. It was a network of bots speaking solely to other bots. And that lone sell order was about to reveal just how brittle the whole setup was. The sell order wasn't huge by any historic yardstick. Yet in a speed-addicted market, size mattered less than timing. Source: Wall Street Journal. The order slammed into the futures market at 2:32 p.m. ET. The E-mini S&P 500, arguably the world's most liquid contracts, started to wobble. Algorithms built to react in milliseconds began pulling liquidity, not out of panic, not out of fear, simply because their models instructed them to. Then the cascade kicked off. Source: CFTC report. Market makers, once the bedrock of stability, turned into liquidity takers. Their models, meant to profit from tiny price moves, suddenly saw only risk, so they pulled back, quotes disappeared, bid-ask spreads blew up. The market wasn't merely falling, it was vanishing. On the trading floors, brokers gaped at their screens in disbelief. Orders got executed occasionally at absurd prices while nobody was left to fill them. Source: NYSE report. By 2:42 p.m., the Dow had plunged almost 700 points. Then just as fast it started to climb back, but that wasn't a rebound, it was the system rebooting itself after nearly collapsing. What had just happened? The answer didn't lie in a single algorithm, it lay in how they all interacted. Source: Financial Times. Some strategies were built to anticipate panic. Take momentum ignition models, for example. They were coded to flood the market with sells once they sensed a downtrend, feeding on themselves and speeding the plunge. Others acted as market makers supposed to steady prices, but in truth they were liquidity ghosts. They flashed buy and sell quotes for milliseconds, then vanished as soon as the market got rough. These weren't rogue programs, they were just standard operating procedures. Source: SEC report. And the regulators, they were watching but not really seeing. The CFTC later conceded their systems weren't designed for a world where machines trade against each other faster than humans can react. Source: CFTC report. Leaked internal messages from a high-frequency trading firm captured the panic in real time. Traders scrambled to kill their algorithms as prices spiraled. One note said, "We're being run over by our own models." The market wasn't merely volatile, it was self-destructing. But here's the chilling bit: no single regulator saw the whole picture. The SEC had the data, the CFTC had warnings, the exchanges had order flow. Still, nobody connected the dots quickly enough. The sell order wasn't the trigger was a break-free system. And when the dust settled, one thing was crystal clear: the flash crash wasn't an accident. It was a stress test, and the market failed. Source: Financial Times. The regulatory blind spot wasn't merely technical, it was philosophical. Markets had been rebuilt for speed, not safety. Algorithms didn't just react to events, they created them. And when the algorithms turned on each other, regulators were left with spreadsheets, not solutions. The question wasn't who pressed the button, it was why the system had no failsafe. Source: SEC report. Because in a world where trades happen in nanoseconds, human oversight isn't just slow, it's irrelevant. And by the time anyone spotted it, it was already too late. The screen glows red again. The same patterns repeat, not in 2010, not in a single market, but everywhere automation spreads. And the next time the system might not bounce back, that wild 2010 flash crash, it didn't just spook traders, it left regulators with a major case of never again that still shapes how they look at algorithmic trading today. The SEC's official take. One giant sell order from a single trader set off a domino effect of automated trades that sent prices spiraling in seconds. Source: SEC report. One order, a few seconds. That's all it took for the commission to completely rethink the game, tightening up order size rules and forcing high-frequency firms to install pre-trade risk checks before they could even think about hitting execute. But the SEC wasn't the only one playing cleanup. The CFTC's deep dive into what went wrong pointed the finger at the messy tango between high-frequency traders and market makers, calling it a major reason prices spun out of control. Source: CFTC report. That finger-pointing, it kicked off a wave of circuit breaker rules, automatic pauses that kick in when prices move too fast, now baked into every major U.S. exchange. Tech didn't get off easy either. NYSE numbers tell a scary story. Liquidity just vanished in a heartbeat, dragging the Dow down 9% faster than anyone could blink. Source: NYSE report. Exchanges fired back by cranking up transparency, rolling out real-time order book feeds so traders could actually see supply and demand before writing checks their algorithms couldn't cash. Meanwhile, the pressure on algorithmic platforms got real. New rules forced them to embed kill switches that yank positions fast when the market turns into a desert. The Wall Street Journal tracked how this all unfolded, blaming the perfect storm of a massive sell order colliding with algorithms pulling liquidity like it was going out of style. Source: WSJ article. Still, like the Financial Times keeps reminding everyone, the system's got holes. Their analysis screams that automated systems can torch prices without a human in sight. Source: FT article. Today, the big questions linger. Are today's stress tests tough enough to handle the next wave of speed traders? Do we really get how machine learning models might freak out during a black swan event? And here's the kicker: what happens when a bunch of bots all trip over the same strategy at once? These aren't rhetorical questions. Ignoring them isn't an option, it's a liability. If you're sitting on the sidelines wondering how hidden market forces could wreck your portfolio, maybe it's time to tune in. Every week, we rip back another layer of the financial onion, turning what looks like gibberish into stuff you can actually use. So, ready to dive deeper? Hit the link below and grab our free guide on shielding your money from sneaky market bombs. Knowledge is the original volatility killer. Let's keep this conversation alive.